been to save more and borrow less. But tonight, the Bank of England's Deputy Governor tells this programme right now we must save less and spend more. Britain's 22 million savers have felt increasingly squeezed by 18 months of rock-bottom interest rates. But in an exclusive interview with Channel 4 News tonight, Charlie Bean says that whilst he sympathises, savers may need to eat into their nest eggs to boost their income. Our economics editor, Faisal Islam, has this special report.
Do young people need to save money?
In our schools, they're trying to reintroduce the savings culture to children born of and in the world's biggest spending and credit boom. The 12 and 13-year-olds at John Warner School in Hertfordshire are getting an early introduction to the value of savings.
So, how many of you think you are already, or think you could possibly end up being a shopaholic?
But is there any point teaching young people to save when the incentive to save, the rate of interest, is so low?
Some children, they just want everything to fit in, and sometimes they just can't afford it, so it's just, you need to save some money.
It's better to save money to pay for like stuff that you really need.
You just got to have a little bit of self-control on what you buy. Then you actually have money to spend, but you still have enough money for other things as well.
The governor gets more letters from savers complaining when we put interest rates down than he does from borrowers when we put rates up. So we're very aware of the different interests of different sectors of the economy.
Bank of England interest rate decisions are often seen through the filter of how they impact upon mortgage borrowers, but the decisions made right here are impacting profoundly upon savers too. Take somebody with a savings pot of £100,000. 2 years ago, they'd be earning just under £6,300 in interest per year as their income. In just 2 years, that's gone down to just over £2,500, a startling reduction of 60%. What goes for individual savers also runs for the economy as a whole. Borrowers, as a mass, have gained by £26 billion because of those interest rate reductions, but savers have lost by £20 billion. That's a direct transfer from savers to borrowers. Bank of England Deputy Governor Charlie Bean is one of the 9 people who decides interest rates, so his views count. He says he fully sympathises with the predicament of savers, but his message was uncompromising.
What we're trying to do by our policies is encourage more spending. Ideally, we'd like to see that in the form of more business spending, but part of the mechanism that might encourage that is having more household spending. So in the short term, we want to see households not saving more, but spending more.
So actually this disincentive, this bad news for savers is it's the point of what you're doing.
It is indeed, or it's part of the point. It's not a side effect, it is actually how monetary policy works.
But for people like David Leaves, that means a noticeable hit to their standard of living. Savers are losing thousands of pounds in interest income, the prudent paying the price for the crisis of excess credit.
I've tried to save, be prudent, save for a rainy day. Now I feel actually very angry and bitterly disappointed. The majority of the people, I don't think really, especially the youngsters, don't seem to understand what saving means. I don't think they really appreciate the problems that have been built up.
Mr. Leaves trawls the internet looking for any sign of higher returns for his pot of savings, and millions in the same situation received this unexpected advice from the Bank of England.
Savers shouldn't necessarily expect to be able to live just off their income in times when interest rates are low. It may make sense for them to eat into their capital a bit. Conversely, of course, when interest rates are high, they might want to build that capital back up again.
Right now, the nation's banks, especially the state-owned ones, are profiting from borrowing cheaply, paying poor savings rates, and then lending at high rates. This is helping banks return to health, says Charlie Bean. But these banks won't raise their savings rates until his bank raises its base rate. Now, no one thinks that interest rates will stay at 0.5% forever, but the mood music here is very much that low interest rates are here for years rather than months. If you're a saver, should we be getting used to a kind of structurally lower level of returns on savings?
It's
Is
not-
this the new normal?
No, I would certainly not expect the level of bank rate to stay very close to zero for a decade or more.
Why do you want to buy all this stuff? Why do you actually think that as teenagers you want all of this? Tim?
So these children now have a fairly good excuse to spend more and save less. The so-called policy paradox that eventually saving needs to be higher to rebalance Britain's economy away from credit and property bubbles.
She has a Ted Baker bag for school and she has all the latest gadgets.
But right now the bank freely acknowledges it's doing the opposite, intentionally squeezing savers to get spending higher to see the economy out of a once-in-a-century financial crisis. That paradox has now lasted 2 years and counting, raising fears for Britain's long-term savings habit.